Welcome to Trump Wire, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Welcome back. Big news. Canada just signed deals with 11 new trade partners, forming a fresh economic alliance. The shocker? The US isn't included. For decades, we've been Canada's top trading partner. This signals a major pivot, with Canada building new bridges and letting old ones fade. The impact? It could hit everything from jobs to supply chains and the future of American industry. Today, we'll break down what this means for 7 major US brands now facing serious trouble. We'll dive into what's at stake for them and for all of us. Stick around. You need to know this. First up, Ford. The F-150 is America's best-selling vehicle, but its production depends on a seamless US-Canada supply chain. Engine plants in Ontario feed assembly lines in Michigan and Ohio, with parts crossing the border multiple times. Now, new trade barriers threaten to disrupt this finely tuned system, driving up costs and slowing production. Ford's competitiveness is at risk, not because of engineering, but because of a fractured economic border. The stakes couldn't be higher for one of America's most iconic brands. Next, General Electric, GE. From jet engines to turbines, GE's operations are deeply tied to Canada. Their aviation division collaborates with Canadian aerospace firms, and their energy business relies on cross-border logistics. New trade barriers could snarl these partnerships, delaying production and inflating costs. A part made in Ohio for a Quebec-built aircraft could get stuck in customs, slowing everything down. GE's global supply chain depends on Canada as a key link. Now, that link is threatened. If European or Asian rivals get better access to Canada, GE could lose out on major deals. It's not just about products, talent and innovation flow across the border too. If engineers and researchers can't collaborate easily, progress stalls. GE has spent billions building a North American system. Now that system faces fracture. Uncertainty is poison for big business, and GE is being forced to rethink its entire strategy. The risk? Losing market share, slowing innovation, and dimming the lights on a storied American company. The gears of GE's machine are grinding against new obstacles. For GE, this isn't just a trade issue, it's an existential threat. The North American model they've relied on is at risk. The question, can GE adapt before the lights go out? The stakes are massive and the clock is ticking. Now, McDonald's. The Golden Arches rely on a cross-border supply chain for everything from sauces to packaging. Tariffs on simple items like paper cups or plastic lids could add up to millions in new costs. McDonald's faces a tough choice. Absorb the costs, raise prices, or overhaul their supply chain. Finding new Canadian suppliers for every item is a huge challenge, and could hurt product consistency. The brand's promise is that a Big Mac tastes the same everywhere. That's now at risk. Disruptions could mean different buns, fries, or even sauces in Canada. McDonald's North America has always operated as a unit. Now Canada becomes a more complicated, costly market. More overhead, more complexity, and more risk. For McDonald's, this isn't just about burgers, it's about the daily flow of goods that keeps the business running. Serving a simple meal in Canada just got a lot harder, and that's not a recipe for success. The fast food giant faces a supply chain headache with every order. CocaCola, an American icon, but its North American empire depends on cross-border trade. Coke's secret concentrate is often made in the US and shipped to Canadian bottlers, along with key ingredients. New tariffs or trade barriers mean higher costs for every can and bottle. Coke must choose eat the cost or raise prices, risking market share to new competitors from Europe or Asia. Their vast portfolio, Minute Maid, Dasani, Vitamin Water, relies on agricultural inputs that cross borders. Disruptions could drive up costs and squeeze profits across dozens of products. The bottling and distribution network, built for speed, now faces delays and paperwork. A truck stuck at the border means empty shelves and lost sales. Coke's century-long dominance in Canada is suddenly vulnerable. Competitors could swoop in, chipping away at market share. The simple pleasure of a Coke is backed by a complex system, one now under serious pressure. For Coca-Cola, the fizz is at risk of going flat. Boeing, another American titan with over 200 Canadian suppliers building everything from landing gear to avionics. This partnership fuels innovation and jobs on both sides of the border. New trade barriers threaten to disrupt the flow of critical parts, risking costly production delays. Every hour a Dreamliner sits idle costs a fortune. Meanwhile, European rival Airbus could gain an edge if Canada gives them preferential treatment. Boeing's defense contracts with Canada are also at risk. A cooling relationship could mean lost deals for fighter jets and patrol aircraft. The North American aerospace cluster, once a powerhouse, faces erosion. If the flow of parts, talent, and investment slows, the whole industry weakens. For Boeing, the skies over North America are looking stormy. The risk isn't just lost sales, it's losing a strategic partnership built over decades. Turbulence ahead for one of America's most important exporters. Procter & Gamble, behind brands like Tide, Pampers, and Gillette, relies on a tightly integrated North American supply chain. Plants and distribution centers on both sides of the border work as one. New tariffs or regulations could add hundreds of millions in costs, forcing P&G to rethink its entire operation. Separate production runs for Canada destroy the efficiency they've built. European rivals could now undercut P&G on price, tempting Canadian shoppers to switch. Brand loyalty is strong, but not always enough to beat a cheaper alternative. Launching new products in Canada could become so complex and costly that P&G delays or skips them. The core business model, scale and integration, is under threat. Every added friction or cost is a major problem for a volume-driven company. From detergent chemicals to razor handles, the whole supply chain is at risk. For P&G, this isn't just a business challenge, it's a threat to their daily presence in millions of homes. The world's biggest consumer goods company is suddenly on shaky ground. Walmart, over 400 stores in Canada, but their low prices depend on a hyper-efficient supply chain running through the US. New tariffs or border delays hit Walmart's bottom line hard. With razor-thin margins, they can't absorb the costs, so prices for Canadian shoppers will rise. Canadian-based competitors could gain ground. Fresh produce and groceries, much of it from the US, could face shortages or price hikes. Walmart may have to reconfigure its entire supply chain, bypassing the US and shipping directly to Canada. That means abandoning a multi-billion-dollar US distribution network. The result? Two separate, less efficient supply chains for the US and Canada. For Walmart, this is more than a headache, it's a direct threat to their business model. The promise of everyday low prices is at risk. The world's biggest retailer faces a supply chain squeeze like never before. The foundation of their North American success is under assault. So Ford, GE, McDonald's, CocaCola, Boeing, P&G, and Walmart, all facing a new reality. Canada's pivot away from the US could disrupt everything from jobs to prices. These 7 brands are just the start, many more could be affected. The effects will ripple from boardrooms to factory floors to your local store. In a global economy, political decisions have real consequences. The road ahead is uncertain, and these companies must adapt fast. What do you think? How will this impact the US economy? Let us know in the comments. Subscribe for more updates, and thanks for watching.